Hello, everyone. Before we get started on today's podcast, we have an announcement. If you're heading to the Markel Group reunion this year, there is a new event you want to put on your radar. The inaugural Richmond reception, hosted by yours truly, the Value Seville team. The idea is to bring together long-term investors, operators, and original thinkers for an intimate afternoon of real ideas. Not hype, not panels, real ideas. Think TED Talk style talks, roundtable discussions on capital allocation, and plenty of time for offstage conversation with peers who are actually doing the work. Please plan to put it on your calendar. The event will be held May 19th, 1 p.m., Richmond, Virginia. You can get more information on our website, valueseville.com/Richmond reception. Again, please hit our website, valueseville.com/Richmond reception. You can learn more there, sign up for the wait list, and we hope to see you all in May. Now to our podcast.
The information provided in this podcast is for educational and informational purposes only and should not be construed as investment advice. We are not financial advisors, and nothing discussed on this podcast should be considered a recommendation to buy, sell, or hold any security. All opinions expressed are those of the hosts and guests and are subject to change without notice. Listeners should do their own research and consult with a qualified financial advisor before making any investment decisions. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results.
All right. Welcome, everybody, to the Value Seville podcast. I'm your host, Jeff Hendrickson, here with my co-host, Donnie Sitar. And today I'm coming from Florida. I'm still... I didn't go back to Virginia for the storm. I'm still down here in Florida. Donnie, I believe you're in Hawaii, too. You got the hell out of the cold.
Yeah.
Is that correct?
Hunter,
where are you at today?
Negatives in Minneapolis.
Are you in New York? Where are you at, Hunter?
I'm in the frozen north. I'm in New York City, where the snow is not. I don't think we've had an inch of snow melt since the storm. It's like the day it happened here still.
So we got some people farm sitting for us in Virginia, and I got a video the other day of one of the girl who's farm sitting. Her boyfriend was sliding down a hill in our back pasture, and dude, it was like just solid ice. And it's been that way, yeah. I mean, since we left, I think almost. But in any event, okay, today Hunter Hopcroft, 3-time, not one, not two, but 3-time Value X attendee, or Value Seville now attendee. Hunter, you and I met the first Value Seville that we did, and through our really good friend Cal Levine, who was also on the podcast. And Hunter I think you are one of the most thoughtful, like deep thinking, cerebral investors that we have. And I'm not saying that. I mean, I always say nice things about our guests and all that, but I'm not saying that just to build you up. I mean, really, if you read Hunter's writing in American Affairs, you'll realize, you read an article or two and you'll be like, wow, this guy really thinks about issues deeply at a level that many of us just hope that we could think about to try to really unpack, very complex issues. And so, Hunter, thank you for being with us today. Hunter also works in the defined contribution space. So we're going to be talking today a lot about private credit and about asset allocation and about markets, theory of the firm, all kinds of interesting stuff I think we'll get to. But Hunter, let me shut up and give it to you and maybe give us a brief intro and your background, man.
Sure. Well, I appreciate that introduction. Most people, like Donnie, I think, came into investment management through an investment banking track. And I came directly into working for an RIA as an alternatives investment analyst. That was my first job out of undergrad. And so I appreciate your intro, but I think my approach to market comes from having to learn it from like a first principles perspective. I didn't go through an investment banking training background or anything. I was sort of thrown into the frying pan and had to figure it out. And while in many ways that was a detriment, I think it has ultimately been a positive that I had to sort of think about these things with a blank slate. What's really happening here, and try to understand them from really like the ground up. And so that's shaped a lot of my views. So I've worked across the asset management spectrum, from RIAs to family offices to large asset managers. I actually work for a fintech startup now that's in the defined contribution space. So that's 401k plans, retirement plans, which I imagine we'll get to at the end about where this intersects with alternatives and private credit, because there's definitely a linkage here. Most people think of like defined contribution as like a really sleepy area of the market. But you're talking about, somewhere between $50 and $90 trillion of assets that are being sort of perfunctorily or, automatically invested. And so changes to that market have really big downstream effects. And so obviously the rise of alternatives, changing attitudes towards asset allocation in terms of how much of a diversifier stocks versus bonds are, all of those things, once they hit the defined contribution space, that change in flows has big downstream effects for every part of the market. The same way indexing had big changes for every part of the market.
Well, I mean, and we have not had Mike Green on our podcast. I'd like to have him on, but the king of how passive investing is affecting markets and valuations, and that's a huge part of it. Is how retirement assets are invested, specifically via target date funds, and how they're allocating basically just reflexively to the passive indexes, and how that has this mean expansion effect potentially on valuations. But we're not here to talk about that. We're here to talk about private credit. All right. And I'm like really excited to talk private credit because it's an area that for those of you that don't know, I teach, I've taught with Turning the Street, and I teach a program at the University of Chicago with one of my finance mentors, Andreas Angelopoulos, who, if he's watching, hello, Andreas. And his entire background is in credit, right, and leveraged finance. And so I really got introduced to private credit through him, and I've learned a lot about it. And as a manager of a family office and as an allocator, I believe that it is a very appropriate asset class to allocate to. That said, it's going through right now a media cycle that is super negative, given a handful of the issues we've seen in the space. Right, and comments made by Jamie Dimon. What were the companies? Yeah, I'm forgetting. First Brands was one that went. Tricolor was another. And so people are like, "Oh shit, it's the next shoe to drop. It's the next thing." And the guy from is it Gundelock? I heard him make a whole thing on CNBC, and it's like, oh my god. And like I know from the people that I know in private credit, they will say it's all about getting good GPs. It's all about finding GPs that have an edge in underwriting. But before we get there, and so I just think this is a very interesting subject to go into, especially given where we are kind of in the narrative cycle with regards to private credit. So before we start
to that too, is like as a public markets investor, I think we talked about this a little bit before we started recording, is that it's in its own private credit is its own class. That's a class that if you're not following it, you just only see the headlines. It just doesn't seem to make its way into the public equity space, at least directly. But I think there's a lot of indirect. And now actually even in the late stage venture space, which is where we've evolved to, we still don't see it much, but I think it's there and it has a very profound impact. And it's really important to understand it. So I'm hoping today, Hunter, you can kind of start with the 101 and build us up that, I think anyone who could, hit play on this podcast would leave knowing, what it is and where it could affect us, both from an allocator perspective and from a public market, late stage private investor. I think that would be where we would, be a good goal for us to get to today.
Yeah. Hunter, do you want to start? Yeah. Just by giving the listeners a good overview of private credit in the history.
Let's just start with that question. Yeah. What is private credit?
What is it? Where did it come from? Pretend Donnie and I are complete neophytes and explain, as my favorite finance movie Margin Call would say, explain it like we are a golden retriever.
Sure. And I think I want to caveat this conversation a little bit because we're certainly going to talk a lot about private credit and use that as a lens, because I think what I really want to use private credit to describe is what I think is a secular evolution of markets about how companies choose to capitalize themselves. And so focusing on the debt side of the balance sheet, we'll say there's three main sources of debt that a company could go out and raise. One is some sort of bank lending. And whether that's a bank giving a company a credit revolver, or they're doing some sort of broadly syndicated loan where the bank is going to underwrite a loan and they're going to syndicate that out to other banks. That's one type. There's obviously the public credit markets where a company will go out and do an investment grade or some sort of high yield issuance that will be publicly traded that lots of investors and allocators will buy. And then the third one, which is sort of new, but it's not that new, it's just much larger now, especially after post-GFC, is private credit. And what differentiates private credit, at least historically, relative to the other two, is the other two are a one-to-many transaction. A bank might underwrite a broadly syndicated loan, but ultimately that loan is going to be funded by a bunch of different investors. Clearly, an investment grade issuance or any sort of public bond issuance is the same. There will be an underwriter, but it's going to get distributed out into a lot of other different allocators. And what that means for those one-to-many is that the terms, the docs, the credit agreements have to be sort of in the structure of a traditional security. Everyone buying it needs to understand the rules of the game. Private credit's a little bit different in that historically, and this is starting to evolve itself now, it's a one-to-one relationship with your lender. So you call up Apollo, you call up Blue Owl, whatever, they write you a term sheet. But if things go sideways or things aren't going right, they just pick up the phone and call Apollo and say, hey, let's hash it out, And that's I think one of the biggest differences of private credit. The key thing to understand is historically ways companies have raised debt capital has been a one-to-many relationship. Private credit can be thought of as a one-to-one relationship.
Hunter, real quick question there. The traditional bank structure, you might have traditional LBO, term loan A, B, C. You might have a high yield bond, some mezz. You get this whole thing. The private credit, they'll come in and take pretty much all of that or most of it in kind of these unitranche facilities, right? Is that mainly how it's done?
That's right. I mean, again, there's John Zito has this great thing. I was at the Grants Private Credit Conference a few years ago, and he said, if you go on Wikipedia and you type in French fries, I think the Wikipedia entry for French fries, he said, had like 4,000 words. And if you go to Wikipedia and type in private credit, it's like 250 words, or at least it was, a year or two ago. And he's like, private credit's more like French fries. There's like so many flavors of this that it's really hard to be reductive about it. So aside from the one-to-many versus one-to-one differentiator is also the source of that capital. So in a bank, it's a depository institution. Lots more regulation, capital requirements, lots more oversight about how that bank can lend, even for a broadly syndicated loan. Investment grade, high yield public bond issuance. The source of that capital is the public markets. That is driven by all sorts of flows and dictated by all sorts of considerations about what you can actually come to market with at any given time. Private credit, funded primarily by either large LPs or increasingly by other large pools of capital, i.e. insurance, endowments, pensions, things like that, but not without the regulatory wrapper of a bank charter, without the considerations of having to go out and shop it to a public market that may be responding to a bunch of other different factors. So I think those are the two main differentiators that make private credit. And then the other thing I would say is, and this is a broader, almost like philosophical point of, there is no hard line in the sand of when something becomes debt, when something crosses over and says this is debt versus this is equity. And I think private credit increasingly flirts that line of, is this really debt? Is this structured like debt? In a way that a bank.
I mean, but with a debt instrument, we could sit here and argue this all day. The first thing that comes to mind is, if I'm a holder of that instrument, is I have contractual cash flows coming my way. I'm not relying on some residual value and hope somebody is going to value the equity more than I paid. It's like, I've got a defined set of cash flows, and I care about whether or not the company can generate enough unlevered free cash flow to service all the debt obligations, interest, and principal. I get paid. I'm done.
That's not even quite right, because, and we should save this as we get into the evolution, but private credit is working a lot of liquidity. What you're describing is a traditional debt instrument. There's coupon payments and a maturity, and then you signed up for an upper limit of your return. Everything went well. You got your payments, and the debt was retired, and you got out at what you thought you were getting out at. Private credit is, and a lot of this happens on the real estate side. Again, private credit's a big umbrella. They factor in a lot of liquidity to the covenant structure. If this happens, we get warrants. If this happens, we have some sort of step up. If this happens, and that's how I'm talking about.
This happens.
Yeah, exactly. And so that's where it gets a little bit more muddy about what is actually the return stream and where is it coming from here. Because yes, on the blackboard, it's, interest payments and maturity. In practice, it ends up being basically a document that contains lots of embedded options for the lender. And that's why I think it's hard talking about the news cycle or people citing metrics. They say, well, private credit spreads are wide of high yield and it's not wide enough because of this and that. It's like, well, these are such idiosyncratic instruments that spread is really hard to put a fine point on when you factor in all of these liquidity mechanisms that are worked into the covenant structure of, let's say, a private credit deal.
Well, I think it'd be helpful for me. I think just like in the vein of thinking like an operator. Okay, let's just take the borrower's perspective here. Who are these borrowers? Is it me, who I own this regional HVAC shop and I want to expand and I need to go get some money somewhere? I could, like you mentioned, the three different structures. There's and on top of equity, but I want to go find something that's attractive for me. Is this the type of borrowers? Like, who are these people that are actually that want this money? And I guess why not through the banks and the traditional banks? Like, what's the benefit for them? Because you're talking about a lot of sweeteners later on, but that's all cost, right? So I'm just wondering, if I'm just a guy who runs a shop in the Midwest, what do I do here? Tell me, walk me through this, Hunter.
We might, I'm going to give a very long answer to this because I think this might be a good place to infuse some sort of a historical arc into how we got here, because it'll help answer your question. We really have to go all the way back to the 80s and like Michael Milken and the junk bond revolution. And, what Milken figured out was that these LBOs can be incredibly attractive from an investment standpoint, to issue high yield debt to a highly levered company for a buyout, something like that. When that market collapsed, you had firms like Apollo and the original sort of credit shops come up, and they were sort of effectuating a private equity strategy through the debt side of the balance sheet. They saw some really nasty situation like a Samsonite or something, and they determined that they had a better chance of stepping into a great asset through the debt side than they would ever trying to do a traditional buyout or be an equity position in it. Caesar's Palace coup and the situation with Caesars kind of exemplifies this. And that defined, I think, high yield and whatever was private credit pre the GFC. Is it was leveraged buyout. It was a symbiotic relationship directly with private equity. That's the two existed and grew alongside each other. Private credit grew as private equity grew. GFC happened, Dodd-Frank's, banks are, effectively jammed down, more or less nationalized in what they can do. And so that opened up the breadth of what private credit could become. And for several years after the GFC, it continued to sort of grow in lockstep with the growth of private equity. But then it started expanding beyond that to asset-backed and sort of capital-intensive companies. You can think of like consumer lending companies, any sort of credit originator that their actual business is their operating business is relatively asset light, whether you're originating car loans or home equity loans or something like that. But the product you sell requires a bunch of capital. If you're originating debt, whether it's consumer debt or housing debt, you don't want to fund that with equity. You need another capital source. You want to separate that from your operating business. And so increasingly, private credit has moved into this sort of asset-backed space. LBOs are still a big part of it, but becoming less of a part of it. Some growth capital for sure. We can get into that. So that's a long-winded way of answering your who. Who previously, it was sponsor-backed lending. Now it's sort of anyone that either has a capital-intensive business, either the actual physical capital they need to effectuate their business model. You can think of like these new wave defense contractors or people that are doing hard tech or things like that, the way they need to, that's never going to support you can't fund a manufacturing facility with venture funds. That's just not how the cost of capital works. Or these sort of asset light originators that are originating various consumer loans that need consistent credit to sort of effectuate the business model. And then the third is exactly what you're saying. Now, yes, there is like a really low end of the business, which kind of lower middle market companies that just need either working capital or growth capital. But at this point, I think it extends up to a much higher market cap company that's looking at a capital market without a great option. Unless you have some sort of mimetic appeal, you're not going to get a multiple on public markets that's attractive for growth capital. Private equity comes with a host of challenges as well. And so what you're left with is you're looking at private credit, and you or I might say, wow, S plus 500, S plus 700, that seems really expensive. It's actually cheaper than the other options, especially on an after-tax basis. And so to your point about there's this sort of, I think is another post-GFC, instinct. Oh man, there's a lot of capital rushing into this space. Surely this is bad for future returns. And there's always this feeling that every growth of any asset class is driven by the supply side. Oh, there's too much capital chasing too few deals. I think private credit's a little different. I think there's a ton of demand for this type of lending from all sorts of different borrowers, and the market is just coming to meet it. It's not that there's too much capital rushing in. It's that there's a lot of people where this is looking like an increasingly attractive source of financing their business.
I mean, I guess I would say too, just on the LBO front, how much, I don't know the number off the top of my head. Maybe, Hunter, the total dry powder in LBO land right now. It's a big freaking number. It's in the trillions, I believe.
Yeah, 3
Three or
trillion or
four.
something. Yeah.
I mean, probably a large percent of what will ultimately be those deals is going to have to get debt from private credit, correct?
Yes. Yes. Inevitably, whenever that unlocks. But I do think private credit in general is trying to move away from that, as they want to break down that correlation. And a couple reasons they want to do that. One is because that has been shown to be a more volatile growth driver than it was. Deal M&A freezes up. Deal volumes slow down. It was good. It was good when it was good. Private equity was growing. Private credit was growing in lockstep. They need to diversify away from that being the sole driver of private credit. Why do they diversify away from that being the sole? Well, that is partially a supply issue. There is a lot of people that are attracted to this yield. Um, the other reason is those were almost always non-rated or sub-investment grade deals from a credit perspective. Private credit has increasingly moved into the insurance space, and they need to be originating investment grade private credit. They need to be thought of as on par with a AAA, AA public market issuance for the large pools of capital that either have mandates or regulatory requirements to invest in investment grade. And so private credit has expanded beyond this LBO to include a lot more things that are asset backed or that have a path to receiving an investment grade rating or an investment grade from day one. And so that's been part of the evolution, certainly over the past 3 years, as a much, much bigger push into originating investment grade paper versus always originating some investment grade high yield deals.
I think some of the I guess maybe competitive edge, and maybe I'm wrong on this, but is that the originators of these loans could do the sophisticated work that you're mentioning in underwriting assets that may be difficult for a traditional bank or somebody else. But now we're kind of going back to the rating agencies. So are we now in a situation where the rating agencies are the gatekeepers part two, like we were, we've seen this cycle before? I mean, is that kind of where we're evolving to, or is it still the prowess of these underwriters? And maybe just that's a kind of understanding like where we're going.
Yeah, I mean, I think there's a general misunderstanding about the role credit ratings play in the market in the modern era. I don't think GFC is a particularly relevant comparison for that. I was on the phone yesterday with a hedge fund manager that traffics in CMBS, and I was asking him directly about ratings. No one who's managing a credit book is relying on the ratings for their credit analysis. Ratings exist for the manager to communicate with their LPs what's in the portfolio in an efficient way. Ratings are not driving capital allocation in that way. Ratings are kind of this shorthand so that a manager can report down and say, hey, X% of the book is in A, X% of the book is in B. But anybody who's managing credit professionally is doing, if all it took was I'm going to buy all the A's that come to market, it wouldn't be a job. So I don't think the rating agencies have that big of influence. Where they do have an influence is where we get into this growth into the insurance and annuity market, where there are regulatory requirements around what can be in certain parts of the balance sheet. And we can get into that in a little bit. Yeah, ratings play a factor, but I don't think they play a factor in actual origination volumes or how these firms are originating debt necessarily. I will say I think there are things that probably are more esoteric, that don't have the history yet, but that probably will at some point be considered investment grade. Music royalties, for example, lending against music royalties. They don't quite have the history to say, oh, this is an A paper, but I think in time they will. And private credit firms are working hard to build that track record so these more esoteric originations can get investment grade status.
And then ultimately shrinks the yield, and they can sell it at a premium to the insurance or whoever. And so they build that history. So
Exactly.
That's the VIG that you want to build. Go ahead, Jeff.
Oh, no, I was just going to say, from an allocator's perspective, when I look at private credit, the thing that I think attracts me to, and I would probably argue most allocators, are a couple things. One, it's going to have, when you think about like correlations with the overall market with the S&P, it's going to be on the lower end. I mean, it's obviously not zero, but it's not a super high correlation, at least on the way they mark these things, with the S&P. So you get diversification benefits. I mean, that's kind of point one. And point two, these things actually have good yields. I mean, these private credit funds, you're looking at, call it, 9.5 to up to 12% sometimes returns, instruments. So equity-like returns on instruments that sit much higher in the capital structure. Now, the caveat there, and you mentioned Miller Modigliani in one of your articles, and I'd be remiss if I didn't mention it here, is that they are putting leverage at the fund level, right? So these private credit funds, to a degree, are taking LP capital, borrowing some money on top, and then lending, right? And so that's kind of giving you that higher return, which should give you a higher return if you believe we live in an M world. But all of that said, getting, call it, 9.5 to, say 12% wide range returns for something on a cash flow stream that has a low correlation with the S&P, which is, much less volatile. That is very attractive from an allocator's perspective for some portion of the portfolio. What are your thoughts there, Hunter, on how allocators are thinking about, putting money into private credit and the attraction of that return stream?
Yeah, so I'm gonna take them in the exact order you did: correlation, yield, and the fact that on some degree some of these are levered leverage.
Yeah, levered leverage. We said I only like my levered layered. I love layered levered leverage. It's the best kind.
The best private credit index benchmark I know is the one that Cliffwater generates.
That's the standard, right? That's the main benchmark.
And it only goes back to 2005, and that's a backfilled from 2015. So in 2015, it became a live index, and then they sort of took that index and went back to extend it back to 05. So regarding correlation, I think the appropriate answer is we don't know. That captures just one big, in my opinion, long cycle. We don't know what the correlation is really. So from that sort of classic modern portfolio theory perspective, it's always going to look, and I think there's certainly a degree of this, it's always going to look good on your efficient frontier to plug in a private.
But to your point, there's a lot of lending in the last 5 years has gone to software firms, and we see what's happening to software ETFs in the market right now. And so if you had a massive crash of software and you were in a private equity fund that made a lot of those types of loans, you'd find that correlation all of a sudden went way up, right? So
yeah,
I'm with you.
I'll touch briefly on software, one, because it's topical right now. I remember asking a private equity guy, I was like, what does it mean to have a first lien loan on a software company? What are you taking? The office chairs, the monitors? What does a first lien loan on a software company mean? And private equity was viewing it kind of in that old Apollo era thing where, look, if the market dislocates, we're going to be able to step into a high cash flow business at a 30-40% discount. And that's why they were doing these loans. And from the software company's perspective, again, even at a relatively high cost of capital on the private credit, they felt like they had an equity rocket ship, and they didn't want to, even though the cost of equity was very low for them, they did not want to sell any of this sort of like lottery ticket they had. I mean, I remember a few years ago, I was finding Airbnb debt at like S plus 700 in some of these BDC portfolios. Like, why would Airbnb do that? Because they didn't want to give up any more of this company to grow. So that's briefly on the software thing. And then also, a couple years ago, Michael Patterson, HPS, which has subsequently been bought by BlackRock, there were good GPs, and this was way before AI. At the time when he spoke, AI was more like a parlor trick than what it is today. But he said, and he was not referencing AI, he said, we keep our software allocation basically under 10%. He goes, because the businesses are just too easily disruptible. Right. He wasn't even talking about AI. It's just the best solution yesterday is not necessarily going to be the best solution tomorrow.
Somebody makes a better mousetrap, right? And all of a sudden, you don't have assets, and those cash flows you're lending against start to peter. Terminal value questions come to rear their heads, and it's hard to refinance any debt. So.
And then I'll say one more thing about the software thing is that publicly traded BDC that's gotten really beat up this week is Blue Owl has a technology private credit BDC. And if you actually look through the book, it's kind of as a public markets investor, it's your only way to get any sort of access to some like really great companies. And they don't own just debt in there. They own some of the common, they own preferreds. And so putting on my Value Brain ValueX hat, some of these like bombed out BDCs that do have a lot of software, I think they might be some attractive hunting grounds.
Ares public BDC, I think maybe just under a 30% maybe of their loans are software or technology space, whatever they want to call it. And exactly. I mean, it's not down, I don't think as much as Blue Owl, but it's gotten hit this way. I know because I own it. Full disclosure to our guests out there. But yeah, I mean, from my viewpoint, it's that software scare kind of, filtering through.
And that's
helped me to.
Go ahead.
Well, just because we're kind of getting into analyzing it, I want to. There's one, and talking to someone in private equity credit, and one of the narratives is this: that private equity, a lot of these big private equity funds, your Apollos, KKRs, right? That they invested in a lot of these companies, so they're the financial sponsor for company X, and they are selling these. They're using private credit for either to dividend themselves or capex, grow the business, whatever it is. And the narrative is that the private credit is fairly safe because these financial sponsors aren't in the business of subordinating themselves to ultimately get hurt, that they are not going to over leverage them. And so, walk me through, is this still a safe narrative that's out there, or has private credit evolved past it where you no longer care about the sponsor as much? It's really finding a place to put it. And I think that, so that I just want to understand that, because then it helps to kind of get to the analytical framework from there.
Yeah, yeah. This narrative that, well, the sponsor is all over the capital stack, so you have some degree of protection because I think that's not as widespread as people believe it is. And I think the safety, if you want to call it that, in private credit comes back to that one-to-one relationship versus there being a hard line in the sand on default. Then you go into a contested situation where creditor groups form and God forbid you own the preferreds or something, you don't have a seat at the table, or you're, way down low in the capital stack. I think the protection in private credit comes from this one-to-one relationship. And a lot of the stuff people criticize is the company can go back to the lender and say, we need to modify these terms. And that's possible. That doesn't mean there's a 3-year court battle to figure out the outcome. And I think that's true whether a sponsor is in multiple parts of the cap table or not. I think it's important here to give my own disclaimer, and that I feel like I'm really defending private credit and sounding quite bullish here. And I don't, as I pointed out about the correlation, we don't know. We don't know how this goes. We don't know what the next 10 years of private lending look like. But I do think it's worth just taking a sober look at how the market's evolving, how people are using this capital, why they're using this capital. If we start with the notion that a lot of these management teams are pretty smart, some of the CFOs are pretty smart, this asset class wouldn't have grown as much as it has if there wasn't some attraction to this form of capitalizing your business relative to the others. And that's really what I want to sort of center on, is this is happening. Why is it happening?
Yeah, and what I think is interesting is that there is a narrative, and then I could be mistaken, that it's a product of the zero interest rate environment. That there's money was so free and cheap that you could find houses for it in whatever shape or form. And then you had this big inflationary push, and rates blew out, you know, considerably. But private credit doesn't seem to have slowed. I mean, I guess maybe in your mind it's accelerated. Maybe that it's accelerated. I don't know. That's true. It seems that it's accelerated. So it's not like a one narrative asset class. It's something that's broader and deeper, I think, is the point that you're making. So
Yeah.
I think that it's just interesting to see it go through that, right?
And then to hit on, because it's related on Jeff's last 2 points. Well, where does the yield come from? Why is the spread so much wider than high yield if these have such low default rates, if these are equity like returns with the protection of debt? I think that's primarily right. I think one is primarily a function of size, that these loans are much smaller than what you would have done typically in the broadly syndicated loan market, or obviously in a public issuance. That's changing. They're getting bigger. In fact, the Blue Out Meta deal, which is a private credit funded deal, previously to that deal, I think the largest investment grade issuance was to Procter and Gamble or something, some venerable American company.
Business.
And now the largest investment grade issuance is to an entity called Beignet LLC, Beignet Investors LLC.
Makes me want to go back to New Orleans.
Yeah, so it's some Meta SPV that's borrowed all this money from Blue Owl and others to build this giant data center. I just think that is indicative of the secular shift we're seeing, is that the largest investment grade issuance ever now is to an off-balance sheet SPV that no one has ever heard of, and is certainly not as recognizable a brand as, let's say, Procter and Gamble. So I think the yield comes from, one is typically the size of the loans is a little smaller, and there's just a price for that, for a creditor to get out of bed and do the work, and you're only borrowing 50, 70 million, you're going to pay more for it. And then some of it comes from all we were talking about this covenant structure. It's not a straightforward bond. It's not interest payments and maturity. There's all of these various options and embedded terms in there, and it's hard at the outset, if you're an investor, to exactly underwrite all of the possible paths from origination to maturity. And then the final point is the private credit firms using leverage. That is true. I think it's maybe a little bit overstated. A lot of that is like some portion of that leverage, an interval fund can only really go up to like 1.2. The publicly traded BDCs can really only go up to 1.5. Some portion of that is just sort of like perfunctory liquidity management. They want to originate loans. They want to facilitate the business
In
to
capital,
some degree.
yeah, I got you.
Yeah, they're not just, it's not just pure levering up the positions. There's like some liquidity component of it. And so once you strip that out, I don't think the degree to which they're using back leverage is as extreme as maybe the press makes it out to be.
Well, I was going to ask you a very unfair question right now, and I'm going to do it now. Okay, we were going to record this podcast a week ago, but we did have to push for various reasons. And so me doing this, I want to do this in real time. I was planning to do it a week ago. It's going to be even more unfair now. I just want, as like as someone who is not exposed to private, who doesn't think about private credit every day. If you go into the Google and just type in private credit and news and look at headlines. And this is what, in a sense, what you kind of see. And today it's particularly bad because, we're recording on a day. But, here's the headlines that I would see, right? One is New York Times, once the hottest bet on Wall Street, private credit has started to crack. Barron's, Blackstone stock, alternative managers, BDCs dive as software woes infect private credit. Financial Times, private capital giants warn AI risks could slow growth. Wall Street Journal, AI fears sink shares of private credit fund managers. So it's like across the board negative right now. This happens to be a particularly bad time. I was more making the point that if I was, the broader point I wanted to make in this one originally was, hey, look, if you're just picking up in articles on, from the press, because I think it tends to be more salacious than maybe the sober view that you're taking. How to interpret these things? Or I guess, now maybe not a sober time. So I don't know if it's a good way to ask the question, but maybe just leave it, maybe it's a good point to get into some of the topical issues as opposed to just like some of the press stuff. But
look,
anyways,
I can acknowledge the pattern recognition. Rapidly growing asset class, with, as Jeff pointed out, kind of optically too good to be true returns. You can write the story, in any sort of hiccup in that. And then there's also like the sort of fetishization of like the Big Short. Everyone wants to call the next big one. And so I think those sort of three elements combine to be really, useful fodder for coverage of the asset class. I mean, yeah, when First Brands, a month or two ago, when First Brands was unraveling, you would have thought that like some massive company or, some systemically important company had, this was like a, Midwest auto dealership, and people were acting like it was the dominoes falling.
Yeah.
And to be clear, it was almost misattributed to private credit. A lot of that was in the broadly syndicated loan market, not in the private credit market.
Was that the one that JP Morgan actually had a slice of that then Diamond came out and made the comment about, how did he phrase it? I think
Lots of roaches. There's more than one roach in the kitchen.
Which I find ironic that Jamie Dimon, who's, Wall Street bankers who might be in the crosshairs of private credit are the ones bashing it. Same with Gundelof, who's a public fixed income guy. And I wonder, like, it seems disingenuous to me, right? I mean, but what are your thoughts? Is stuff overdone? Like, because in my mind, the people that I know that know private credit will tell you that, there are good GPs and there are bad GPs. The good GPs that have great underwriting, they can source, they can underwrite, originate, and win deals to lend to superior companies at really attractive terms. They are going to do well regardless. And then you hear all this crap in the media about how it's like 2008 again, which I think is way overdone. But what are your thoughts there on that, Hunter? Is this to follow on Donnie's question? Yeah.
The measure of an asset class is not that it always goes up in prints. It's its ability to manage a cycle, in my opinion. And so
that's great.
There's also been a lot of news about redemptions from interval funds. Redemptions from the private credit interval funds are ticking up. But inflows are continuing. People that want out are getting liquidity. New people are coming in. If you could call this a cycle, which I don't even think we're at that point yet, the true test of private credit, the true test of what correlation it has to the broader market or to the credit markets, what the actual realized yields for investors are, will come to light through a true cycle. And so as these things are happening, yes, the headlines will be salacious, but every time we have some news cycle with lots of salacious headlines about private credit, and the dam doesn't break, to me, it sort of continues to strengthen the argument for the asset class that it's able to manage through issues. And so it's not that there's going to be bad deals, there's going to be bad GPs. Can the asset class sort of reach escape velocity where these happen without the whole thing coming apart? And I believe we're moving to an era where they certainly can for a bunch of reasons maybe we can get into next.
Yeah. Well, and I think the question would be if you were to, let's say someone listening to this podcast, and I asked this question now a few times, and I always think it's a good question because it's tangible. But if I hear this and I think that, this is a sustainable asset class, what would I do to just start? I want to spend the next 30 days diving into private credit because I want to make an investment somewhere here. How would I even go about doing that? What would I look for? Who do I call? What is it? What's the steps here to get into this? There you go. Yeah, yeah,
I'm a market pontificator.
yeah.
I do think one thing that attracts me to looking at these, like from a public markets perspective, the BDCs, is especially somebody, Jeff, and you all know I covered REITs for a long time and mortgage REITs, really hard to tell what's going on in there. They don't, they're wrapped in CLOs. That's really the only visibility you get. They don't have loans. Publicly traded BDC, you see every loan. You see every loan, who it's to, when it was originated. I think the
What's a
transparency in the
BDC?
asset.
Just defining it. Like a BDC.
Sorry, yeah.
What is it? Define, yeah.
Yeah, it's a tax election similar to what a REIT is. Business development company is what it stands for. And like REITs, it has a similar tax advantage, if you will, is they go out and originate private credit loans. It's similar to a mortgage REIT, and they have to pay out 90% of their net income. And for that, they don't pay a corporate tax rate. So it's a pass-through entity. The dividends that you as an investor get paid get taxed, but they are not double taxed. They weren't taxed at the corporate level first. A BDC, again, just like a REIT, is a tax election. It's not nothing special about it other than they are doing this type of business and they are agreeing to pay out 90% of their net income. So
Well,
what does that mean?
structurally, the way it works, there's Apollo starts a BDC, a separate company. There's a bunch of money that gets in there through either LPs or them or through debt. They make loans. And that's where you, as a normal investor, if you're a 401k investor or whatnot, can invest through there.
That's right. And then they
And
pay
there
out
are
90%.
public BDCs, right? There's public, which you can just buy the stock, and then there are private BDCs, which you would make. Most of the private BDCs I've seen are run like interval or evergreen funds, where you kind of get quarterly liquidity up to a certain point of NAV, but same idea, right? And is there any difference between public and private BDCs tax wise, or is that all the same, Hunter?
That's all the same. I think the difference is the same as
mark to market, the volatility,
the mark to market volatility of being in kind of a leverage vehicle.
Yeah, if you're in a private BDC this week, your account balance hasn't moved. If you're in any of these public BDCs, you're like, what the is going on with this thing?
But if it's something you're allocating to, these dislocations below book value start to look, like attractive opportunities.
BDCs, my understanding, Hunter, is that private BDCs are slightly better in loan quality in terms of seniority. So my understanding is the private BDCs tend to have a higher percent of senior loans, maybe 80%, whereas the public might be a little bit lower. Is that true across the board, or maybe just in some instances?
I think maybe just in some instances. I think firms like Apollo and the large ones that have private, whether it's like a true private fund, an interval fund, or a semi-liquid BDC, and then a public BDC. I think they're a scale business where they kind of want to feed the same meal to three different diners. And what might happen, yes, is that because all three of those have sort of different underlying cost of capital and requirements. So yeah, that quote unquote unitranche, or however it's tranched out, those might get spread out a little bit differently. Where this gets really interesting is on the an insurance and annuity side, which how much time we have left. Maybe we can.
Oh no! Well, let's do that. You wrote an article on this. We need to, by the way, Donnie, link all his articles into this podcast. But so Apollo bought an insurance company, Athene.
Yeah, 2022. I think they brought it fully on balance sheet. That's right. All of the alt managers had been sort of dancing with the insurance market, either through management agreements or owning minority stakes. That was the case with Apollo Athene. They owned a minority stake. And what they were getting out of that was, it's important to understand, I'm going to focus on annuities because it's kind of the most straightforward business model for an insurance company. Property and casualty and things like that those are more complex liabilities, but an annuity is a relatively straightforward liability. Jeff, you have $100,000. I promise I'm going to pay you, after age 65, I'm going to pay you $4,000, a year until you die. Actuaries are very good. It's a very knowable liability. The insurance balance sheet, and people who follow insurance are going to be aghast at my simplification here, but basically 90-95% of what you're paying in a premium, it has to go into something that is 90-95% investment grade. And then 10 to 15%, the insurance companies can take more equity-like risk with that.
Okay, so if I buy an annuity, just to really keep it simple, roughly 85,000 of that needs to be invested. 85 to 90,000 needs to be invested in investment grade credit.
Right.
Remainder can be in spicier stuff. And so traditionally, that 15,000 might be given to Apollo to invest in private credit, as an example.
Yeah, or private equity. Sometimes even what they would do is the manager would say, well, we'll manage the investment grade. I mean, that's not really a good business. We can only make a few bips on that, but it's worth managing the investment grade portion so that we can and what they would use that equity capital for often was like seeding new funds. They would often be in a GP stake or something like that of a new product they were launching or what have you. Apollo was really bold, and these were always either some sort of either minority investment, management agreement, something like that. Apollo was going to bring Athene fully onto their balance sheet. And if you go back and read the press at this time, they were like, no one liked this idea because, asset managers had been determined to be a great business, a high multiple business. Insurance companies were not. Why would you, as high multiple alt asset manager, bring this low multiple, highly regulated business onto your balance sheet? So the press at the time was not into this idea. Mark Rowan, CEO of Apollo, had this vision that has since played out where he was saying, well, we can take that 10%, right? And we can use that to be the seed capital, and we can spin up and buy and acquire origination platforms. Those origination platforms will originate the investment grade debt that we can feed back into the top of the structure. And now all of a sudden, 10 cents of new equity falls out the bottom.
Okay, so let me make sure I understand this. Let's just say it's 90 is 100,000 in annuity. Let's just say 90,000 of it goes in very plain vanilla investment grade. Now 10,000 can be spicier. That 10,000 then becomes effectively seed capital. We'll raise some other capital. We'll use that as seed to then create a lending platform that can even do more lending. So we're taking the 10 and we're effectively levering it to do a lot more in loans. Am I getting that mechanic correct?
The 10 is getting like private equity economics, GP economics on these. I think Apollo now has 16 or 17 different lending platforms. And so they're getting GP economics on those lending platforms. But beyond that, those lending platforms now can originate investment grade debt that can go into the top part. And so
hence the Ouroboros in your the snake.
Right. And so this is this like financial perpetual motion machine, because now once you've put new investment grade at the top, now all of a sudden new equity has dropped down to the bottom to do it.
Now my Excel model is going to I got to turn on circular references here.
Iterative calculation. So that was really a novel idea. But annuity sales until rates started rising, that was like, that's kind of an antiquated business. Who was buying annuities really? Now they did start ticking up when rates started rising, but what really is happening is a regulatory shift in my space in defined contribution land to install annuities as a part of this asset flow. It started so I worked for a firm called Basic Capital. We have a 401k product. We don't have an annuity product currently. We may launch one in the future, but we don't have one right now. Secure Act 1.0, I believe in 2020, that was sort of the first iteration of this. We had to start disclosing what your annuitized income would be on our statements, even though we don't sell annuities. We're showing people what their annuitized balance would be. Then Secure Act 2.0 started making it so that ERISA, the code that dictates retirement plans, they started allowing annuities to be in retirement plans. And they even recalibrated RMDs to match up with annuity payouts. And you're so, well, why is this happening? Why are annuities starting to sneak their way into these defined contribution plans? Well, the retirement industry has been this amazing compounding snowball. You're taking a little bit of everyone's paycheck, you're putting it in these captive products, you're taking, not a ton, but 25, 50 basis points of fees on a target date fund or an index fund from basically everyone that gets a paycheck in America for the last 20 or 30 years. Well, the problem is you've got this huge bowling ball demographic of 60-plus-year-olds working their way through the snake of demographics, and their retirement balances are pretty paltry. You're talking about an average balance of someone at 65 being like $350,000, the median balance being like $150,000 of people nearing retirement. Well, this is a huge problem for the asset management industry, this slowly compounding snowball. If people actually retire and start drawing that down, is going to melt rapidly. And so the flows going out of these assets. So this regulatory push to install annuities will take those balances and turn them into permanent capital. To say, okay, we'll just take your $500,000 you saved in your 401k and we'll annuitize it. So now we have, relatively cheap permanent capital.
Right. So wait, does that help then solve the worries around the passive retirement flows reversing?
Well, except for that in an annuity, it still has to be 95% investment grade credit.
But if you put it into the perpetual motion machine you described, it sounds like that can,
I think this is where people are underestimating the future growth of private credit as an asset class when 25, 30% of these retirement balances start getting annuitized and there's a giant demand. We were talking about before we started recording, when there is a demand for paper, the market will deliver debt paper if there's a demand for it. And I think there's a huge coming demand for this debt paper from the annuitization of retirement plans. Allianz Bernstein. So when you have a retirement plan, there's a qualified default investment alternative. Every 401k plan now in America has auto enrollment. If you're an employee, you get automatically enrolled at a 3% contribution. If you do nothing, it goes into the qualified default investment alternative. Allianz Bernstein has gotten the DOL to approve an annuity as that qualified default investment alternative.
And by the way, Hunter, this was a big change when it was, you have to opt out instead of opt in, correct?
That's right.
It used to be you had to opt in. And from a behavioral perspective, that when they made the shift, now all of a sudden it's going in. And so what did you call it? If you don't pick anything, whatever you had a name for that, I forget what it was. What is it?
The QDIA. It's a
QDIA.
Yeah.
So now annuities are approved for that, which means this money's going to go there. But how many people are doing what Apollo's doing, right? Is that just an Apollo story, or is Apollo kind of the path breaker, and we're going to see a lot more of this activity across the board?
Apollo is certainly the path breaker, and the other firms were tiptoeing in until they saw Apollo's success with it. And now I think they're leaning much more into this insurance as a source of capital. Because if you look at pull a large pension or endowment report, the institutional capital sponge has been squeezed. If you look at a large endowment or a large pension, they're already in every Apollo vintage private equity vehicle. They're already this is where alternatives coming down market to high net worth investors in the private wealth channel, they had to find a green field to keep growing these platforms. And retirement had typically, because of ERISA, been such a heavily litigated space and so many regulations. It was like, okay, we'll focus on, high net worth accredited investors. But this annuity angle kind of helps them crack into this giant pool of capital without saying, hey, Jeff, now you're buying private equity in your 401k. No, you're buying an annuity. You're buying a guaranteed annuity. Just so happens that 10, 15% of that capital is going to be, basically entering the private capital flywheel.
Where's the rest of the coming from? If they are seeding these lending platforms with the 10%, and that's effectively getting GP economics. Where's the rest of the capital coming from to feed those lending vehicles? Is it just
I think that's still your traditional LPs. I still think that's kind of like pension endowment institutional capital. But the sort of the kind of embedded leverage in this system means that these are relatively capital light structures relative to how private equity has traditionally worked.
All this money going is all going into is it all going to data centers? Like it's just like a lot of money available. You know, what are they using this all for?
Well, I mean, I think, okay, yes, data centers are perhaps hot right now. It's like there's all this build out going. But I do think, and this is more like a political economy point, we kind of exhausted the gains from asset light IP businesses. I'm not going to have a factory. I'm not going to build any physical capital. I'm going to generate some sort of novel IP, a design, a software, and I'm just going to basically collect rents from this IP. And we're going to do all the nasty bits somewhere else. Well, we've sort of like run out the rope on that being a source of economic growth. Everything they said would happen with us doing that never really came to fruition. It was like, well, in the US, we'll move up the value chain. We'll become knowledge workers and we can do, manufacturing somewhere cheaper, like kind of the Ricardian dream. We'll specialize in well, unless you live in New York or LA, that's not true. Like you're driving Ubers or changing bedpans. We didn't move up the value chain. And that's coming to a head politically and all these things. And you're seeing it happen in institutional capital is there's a shift in an interest now in funding physical capital again. There's you look at a company like Andrew or hard tech companies or energy companies now that are getting, at this stage getting venture capital, but these are capital intensive businesses that are really important for us to have here, because I think the economic ripple effects of real capital formation, building a factory, building a data center, whatever, is so enormous that we're starting to see that be incentivized in all of these ways. But to my point, venture funding model doesn't support an asset heavy company. That's just not how the cost of capital works. So I think there's a huge demand for debt for these companies, like a defense tech company that has really novel IP, where the venture firm wants to own kind of the IP portion of that, but they need somebody else to fund the build out of actually making the stuff, of actually making things. Yeah. So Joe Lonsdale's VC, 8VC, and Apollo have a partnership. They didn't really go into a lot of details about what that meant, but I just thought it was sort of indicative of a trend that the marriage of these two, venture capital and private credit, to fund these more asset heavy companies. And maybe I'm over indexing to Apollo's forward thinkingness after seeing what happened with Athene, but they see where the puck is headed. Venture capital is not interested in funding, certainly not this week, a software company, but they might be interested in funding drone technology, missile tech, battery storage. Well, you need a lot of stuff or space industries. You need a lot of stuff. You need a lot of physical stuff to make that business model real. That doesn't really fit for venture capital. We'll bring in a capital partner like Apollo. And when you're a founder and you come to them with this idea, they say, I'm imagining, again, they didn't go into a lot of details about their partnership. They're going to give you a full stack term sheet. The VC fund is buying the opco. We've got credit lined up for you to build the factory. All of this stuff is sort of moving in this direction as we move away from just sort of a asset light IP toll booth driven economy to real stuff again.
Yeah, I think you're exactly right. I think if you look at even the Mag 7 today, you'll find Google happened to report their Q4 2025 earnings yesterday when we're recording this call, and they're going to spend 180 billion in capex. And these are all these businesses. If you go back and look at their capex spend, they were all asset light for decades, and then in the last 5 years, lo and behold, that's completely flipped. So if you're a venture capital fund, if you're a kind of someone who wants to compete, you can't just compete on IP anymore. You have to also have funding. And so this is where your point is I think well taken here, is that, yeah, they're going to have some big chunk of capital that's not just VC IP capital. And this is where the seems to be going. And, I'd also add to that is even you're seeing the Mag 7 is now, they're not unlevered companies anymore. I think it's one of the Thursday.
They're not taking. I will say they're not unlevered companies anymore, but they're structuring the debt very wisely, or
Correct.
wisely or not. They're moving into SPVs. They're moving it off balance sheet. Beignet LLC is secured by Meta's lease obligation on the data center. Like, they're getting relatively creative with the financing here.
Right. I think look at Google. I mean, he said, I think it was Sergey or one of them said that, he would go bankrupt to win this AI battle, and they are going to spend every single dollar. And if you don't have the $200+ billion search revenue to fund whatever you want to do to compete, you have to have this other source of capital.
There's an interesting point to make here, which is that the environment you're seeing now is not an anomaly. The world we lived in through 2025 to 2000 to 2025 was the anomaly. In a prior era, the largest companies in the country were the largest investors. Ford, GE, these companies were massively reinvesting in physical capital each year. This idea of it being sort of an asset-light company that doesn't really have any real need for capital is the historical anomaly, not what we're seeing now.
Yeah. Yeah. Well, it's sexy if you're an 18-year-old and you want to go and get rich quick, but I think to your point, as the maturity has started to take hold and it's evolving. Well, this has been great. I learned a ton, and I think there's been no better dance partner that I know of to just walk us through and get us to a place to be able to understand what's going on. All right, Jeff, you have any other questions? I do have one part I like to always end on with something a little bit different. But I'll let if there's anything else that Jeff has in this topic.
I think we've covered a lot. I mean, I wonder, kind of back to your other point on the marriage of venture with private credit. Does that create a world where, kind of these younger companies that have, as you said, like some kind of IP, but also have this big investment need, and they can get, I think you termed it the full stack term sheet. Your venture funding, your private credit, everything's there. Do these companies stay private then and do not access the public market with this, the same frequency, that companies would like 20 years ago, 10 years ago, whatever? Are you going to have more companies just staying private longer? And if that's the case, if you're an investor and you're wanting to tap into these opportunities, do you need to be looking and thinking about, taking your capital to private markets, or taking some portion of the capital that you're allocating to public and move it to privates just to get access to this? Or do you think ultimately a lot of these companies end up going public? How do you view that in terms of kind of the future of markets in general from an allocator's perspective?
Yeah, I mean, I'm like you all. I love public markets. I kind of make the analogy like libraries. If public markets didn't exist today, you could never build them. It's an amazing thing we have. And so I hate that it does feel like public markets are quite unhealthy. I know it seems crazy to say that when we're like just a touch off all-time highs, but from a company perspective, from a capital markets perspective, I don't think it's particularly attractive to be a public company right now. And I hope that changes. I do think, like a lot of things, that pendulum will have to swing. Databricks just raised like a Series F venture round. I don't really see what the end of the rainbow is there. And so I think there has to be some sort of reset of public markets for these companies to have a long life. Now, this brings me back to like another hobby horse, which is like dividends. It used to, if you're a largely profitable company that needs capital, paying a dividend is a great way to source that capital. That's how it used to be. You paid a dividend to attract shareholders. And so I'm hoping that we're sort of working our way back to something like that, where these profitable companies pay a dividend that supports their share price so that they can go out to capital markets and raise. My favorite anecdote is Moody's manual way back in the day used to quote dividend per mile of railroad track. Companies paid dividends to fund real capital formation, to attract shareholders to fund real capital formation. Today, these companies don't pay a dividend because the idea is just that their mimetic share price, their multiple will just continue to expand on some sort of future state that is, outrageously better. But as we move to a more grounded world where these companies actually need capital to operate, you're right. For 20 years, Google just had to turn on the lights, and they had a business. Now they actually need to do with investing and things like that. So that wasn't a very clear answer. All I would say, I don't know what's going to happen, but I certainly hope public markets make a comeback.
It's you. Yeah, well, I wanted to, Hunter, one of the great things about the podcast was that I got to, I had read your writing at times, but I got to actually just sit and absorb a lot. There's a few lines that stood out to me, and I just picked one. And I want you to talk about it just for a second, but first, I want everyone to hear how wonderful you write. This is a great one. It's in, I think it's Hippocratic Capital Allocation, and it's under the section of confidence and curiosity. And you say, curiosity is confidence's foil. You must be voracious in your desire to understand the world, but judicious in believing that you can make tractable or actionable what you learn. Curious inquiry is the most speculative activity any investor takes. I was like, wow, okay. It set me down a lot of pathways and thinking. I stopped at that line for a moment. And so I just wanted to hear what you were thinking on that. I know you talk about it more in there, but I'd love to hear you just kind of out loud riff on that topic as we end this.
Well, it's funny when you read that, I'm thinking about your presentation last year at ValueX Charlottesville, where you presented on the ad tech platforms. And I was so blown away by like the depth of work you had done. You had spent so much time understanding this market that's really quite opaque. It's hard to source data on. You had made such a huge investment in time. And I think anybody that's come into like a new space or something and done all this work, and it feels awful to do that and then determine that there's nothing there to do. And it's this constant that.
Yeah.
And so I think it's something I just think anybody who is an investor needs to keep top of mind and understand that like the purpose of that inquiry is to necessarily land on a buy sell decision, and that it's not wasted time, that a lot of stuff you learn, you will have other applications, or there'll come a time when it is actionable and you'll have done the work already and sort of know the space, because it is so easy to say, well, I'm like, 80 hours into this, company, I've got to buy it.
Yeah. Yeah. Yes. Get plugged in on
Or
the
whatever.
idea, and those yeah.
But that's the fun part of the pursuit. And I guess my hope when people read that is to lean into just the learning portion, that it will pay dividends. It itself will compound, even if the ultimate decision is to walk away and that there's nothing there.
That is wise words. That sunk cost fallacy right there. Well, this was great.
And sometimes you put the process in and there's nothing there to get the return on. So that is tough mentally.
It's very tough. All right. Thanks, guys. This has been a blast. I'm looking forward to seeing you all in May.
Absolutely. All right. Take care.
We're looking forward to it. And for everybody that joined us today, thanks for tuning in. We are going to post Hunter's some links, if that's all right with Hunter, to his articles below, so you guys can read more about how he thinks about the world. And we will see you guys next time. We have a really interesting guest next week, don't we, Donnie?
We do. We'll keep it going. So we'll
keep
leave
it
it as a
secret.
teaser.
We have a very interesting guest next week, and look forward to seeing you guys then. Take care.
Thanks, guys.